This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. I know there are a lot of new value investors out there, so I'm glad you found this podcast. Welcome to value investing. And now I'm going to cover a lot of topics on this podcast this time because I know a lot of you are kind of struggling to figure out, what do I do? I've decided I want to buy some stocks and I like value, but what does that mean? How do I do it? How do I find stocks that I want to buy? These are all kind of basic questions, but we forget when we've been doing investing for a while that people who are new, really have no idea kind of what they're doing. So I wanted to give some advice today about how to be a value investor and what you should be doing if you're new to it and trying to figure everything out. So the first kind of key thing to know is, what is value investing? And remember, it can have kind of a varied definition, but it's really just about buying stocks that are out of favor on Wall Street. That usually means they're cheap or on sale in some way, but not always. And sometimes that can mean that they're trading for a low price, like $5, $7, or $10 a share. But you can still have value stocks trading at $100, $200, even $1,000. So don't just discount a stock based on what its price is and thinking that it's not a value or that it is a value just based on whatever the price is. So in addition to being out of favor on Wall Street, usually a value stock has some kind of low valuation of some kind. And the number one valuation that most value investors use is the price to earnings, or it's also called the PE ratio. And what is the PE ratio? Well, it is what it says. It's the price of the stock divided by the full year of earnings that company is going to make. So you can find the PE on all the various financial sites. And I urge people to kind of look around on their sites, whatever one they're using. And this may be a question you might have too if you're really new to investing. What financial site should I be looking at? And my favorite, and it's an industry favorite for forever, is Yahoo Finance. So yahoofinance.com. Go over there, and it's mostly free. They do have a pro version of it now, but you can get most of the information free. And right on the front there, you'll see, the PE ratio is laid out there, the price of the stock on the main quote page when you put in a stock ticker. So look there to find the PE ratio. But you'll see on Yahoo Finance's page that it'll say in parentheses, it says PE ratio, and then it says TTM. And that means the trailing PE. So what that means is if you see that TTM near anything on there, including the PE ratio, it means it's looking at the past. So in this case with the PE, it's looking at the trailing earnings. The year before is what it's tabulating there. So let's look at a company on there and kind of see what this means. So I looked at Netflix because I know they already reported earnings, so ticker NFLX. And I know that they're doing better than they were a year ago on the earnings side. So that's the kind of example I wanted to show you. So this year, earnings are expected to rise 58.7% to $9.65. Now, I'm getting that information off of Zacks.com because we have good charts, although you can also find it on Yahoo Finance. But you've got to go under where the earnings section is. So on Zacks.com, it's under detailed estimates, I think it is. And so it's giving me this nice earnings expected to rise, again, 58.7%. So a year ago, earnings were just $6.08. expected to be 965. Now, the 965 is for 2021, and that's just what the analysts believe the company is going to make. So that number will change. The 608 for last year is actually what they earned. That is set in stone now because they've already reported all the quarters for 2020. So 608 is a for sure thing. So Yahoo Finance's PE, because it's the trailing one with that TTM, is looking at the 608. So it gives Netflix a PE ratio of 89 because the stock is still going up, but it's based off of the 608. But if you go to Zacks.com and look at the PE ratio on Zacks.com, which does not have TTM after it. So Zacks.com uses the forward PE. So if it doesn't say anything next to the PE ratio, that usually means it's looking forward. And that means it's looking at least 6 months out forward in the year. And since I'm recording this in February of 2021, Zacks.com is looking at 2021 earnings for its PE. So that would be the 965. So using 965 instead of 608 for the PE ratio means that the forward PE on Netflix on Zacks.com is just 56. So you can see the big difference. It was 89 on Yahoo Finance, but that's based off of last year's earnings. And now Zacks is saying it's at 56 because it's looking at this year's alleged earnings, which have not happened yet. Now, some people hate looking at the forward because it has not happened yet. It could change. We could get a global pandemic like we did in 2020. Estimates could be cut for a company, and then the PE will rise, right? Because those estimates on the earnings side is going down. But that's kind of something that you just have to keep in mind while you're watching the PEs. But I like to use the forward because I think that tells a better, gives you more insight into the story and how the company is performing based on what we believe is going to be happening in the business over the next 6 months to a year. So again, make sure you know what PE you're looking at, but it should say that right on there. So now what else should you do? You've gone over to Yahoo Finance, maybe you've put in a stock. So the key is to find the stocks now. And you can also do ETF investing, but I'm not going to cover that on this episode. I have done other value shows based on just buying ETFs. And I probably will cover those again here in 2021 because I own a lot of the value ETFs and it's a good way to get diversity. So I'm just going to cover stocks because I know they're more fun. That's why I own them. I like to own individual companies in addition to the ETFs. Nothing wrong with doing both at all. So keep that in mind. So value investing really takes patience. Sometimes you are just waiting for a turnaround in the company, and the turnarounds can take a long time. They don't normally happen overnight. And then other times you're just waiting for Wall Street to figure out what you believe is the right story, that they're all wrong and you don't understand why the stock isn't going anywhere. So let's talk some examples about this. So my first example is Canadian Solar. CSIQ is the ticker. So they are obviously in the solar industry and they make the solar module panel things. So now they are right now here in 2021 trading with a forward P of 24. But Canadian Solar used to trade under 10 on its PE for several years. Over the last 5 years, the shares are up 181%. So you might think, oh, that sounds pretty good. This has been a good investment. But for 4 of those 5 years, it literally went absolutely nowhere. So I charted this out to confirm what I've known because I've watched this stock for many years. And I know many of you have been in the solar stocks. They've been a thing for over a decade now. But a lot of times the stocks just haven't gone anywhere. So from the from January 4th, 2016 through January 3rd of 2020, so the start of last year, the shares were down during that 4-year time period 7.2%. So your money is going nowhere. If you're a value investor and you're like, I believe in solar and Canadian Solar is my pick, and the company is performing, it has earnings, it's cheap, it's going about its business, but your money went nowhere. The NASDAQ was up 97% during that 4-year time period. So all you had to do is buy the triple Qs or the QQQM ETF as it is now. That has lower fees, but it's the same thing. All you had to do is buy that. You're up 97%. Instead, you owned Canadian Solar and it's down 7.2. So why stay in it? This is where value investing becomes very difficult. There is no dividend that's paid by Canadian Solar. So you literally were just sitting in it going nowhere. So that's another topic for another day about when to know when to sell and get out of your value stock, because I know I did not own Canadian Solar and I did not think about buying it for value investor during most of that time period. But I'll get into some more of that now too. So my value investor did buy Canadian Solar. That's my portfolio here at Zacks. And we bought on December 4th, 2019. So right at the end of that 4-year period. And it was still dirt cheap. I think it was at like 7 times earnings. The analysts have started to raise the earnings estimates, which is always a good sign something good is going on. And they said that things were turning around in the solar industry and should be looking better in terms of like inventory, pricing, demand, everything. So we decided to dive in there. Shares did sell off on the coronavirus sell-off, like everything did. But as the year went on in 2020, shares recovered. The solar demand did improve. And so the earnings estimates were on the increase. And then Joe Biden got elected president, and the Democratic platform is big on the clean energy, which includes solar. So suddenly solar may get a further boost from U.S. government regulations, U.S. government spending. We don't know yet, but that could be a big influence on the industry as well. So the shares took off on that news. And there are some problems with some of the components in terms of supply because of the coronavirus pandemic. It did hit some factories and some inputs were delayed, basically. So earnings were actually cut on Canadian Solar to end 2020 because of these issues. But the analysts all said it will work itself out and through on the supply side, and they will see better earnings growth again in the second half of 2021. So the value investor, we stayed in it. Shares again are up, but it's now trading at 24 times. But this is a case where you had to be patient for quite a long period of time before your views on solar paid off at all. So keep that in mind. Also, another example of just having patience is actually GameStop, ticker GME, as you all know. And this has been a value trade for several years now, at least 2 years. So Michael Burry, you may or may not know him, but he was one of the key players in the movie The Big Short. If you haven't seen The Big Short, go rent it. And if you haven't, or if you have seen it, you might want to read the book. The book is very good as well. Do either one. And he's featured in it because he started out as a value investor, and then he ended up getting involved in the play on the mortgage-backed securities, and that ended up going in the right direction for him. But now he's back to doing value investing, and he's been in GameStop since 2019. Now, apparently, he did sell some of his position in the coronavirus sell-off in 2020, but as of going into the fourth quarter of 2020, he still had a position. We don't know yet if he remained in that position or what's been happening, if he's sold it when this short squeeze has gone on. We actually might not know that for quite some time because his hedge fund doesn't need to report what's in his hedge fund until about mid-February is when we're going to get it. It's 45 days at the end of the last quarter is when the hedge funds all have to report what they've been doing. So we're still waiting on Michael Burry to see about GameStop. But again, patience is key. He's been in it a long time, and the stock was going absolutely nowhere while everything else was going somewhere, the NASDAQ, everything else. Now, the short squeeze did happen, and if he was still in it, he's coming out, and he sold. He's coming out pretty good on that trade. But for a long time, it's not really going anywhere. So patience is key. And it may take longer to turn around than you realize. You may keep thinking, I'm right. This stock is undervalued. This company is more than what the street believes. But it can take a long time for Wall Street to notice. So keep that in mind. Now, another example of taking a long time is a stock like AbbVie. This is ticker ABBV. And they're a big drug maker. They're huge. So you might think, that's kind of boring. I'm not really into it. But they own Botox. They just bought them. And so that's going to be a big driver. They have Humira, which is one of their big drugs. They'll make other drugs. Over the last 2 years, it's underperformed the S&P 500 quite significantly, 31% versus 41%. But shares are dirt cheap, trading now at 8.4 times. They just reported earnings, another good earnings report. But the street hasn't really cared. They haven't cared that they bought Botox. They've been ignoring it. Warren Buffett's Berkshire Hathaway did buy some in 2020 because it's being ignored, but it's cheap. So a lot of these you kind of have to stick around in while it's being ignored. Now, I own AbbVie in the Value Investor here at Zacks because it is being ignored and it's cheap and I like its products. It also pays a dividend. This is another thing that can be helpful when you're a value investor. Now, dividends, you might think, that's kind of boring. Do I care about a dividend? But value investors hold for long periods of time. And that's longer than a year, usually. You could be in it for several years. So if you can get a dividend while you're waiting for the turnaround story to happen, well, that's helpful, right? Because at least you're getting something for your time, for your patience. And AbbVie has been paying very nice dividend for my patience in the value investor. It's over 5% even now, and the shares are up a bit over the last year. We were even getting even better. And that's quite a high dividend yield. Anything over, I would say 4% is pretty juicy on the dividend side. So don't just rule out dividends. You don't have to buy stocks that pay the dividends, obviously, but dividends can add up over the course of years. So keep that in mind too. If you're going into something that Wall Street is going to keep ignoring for some time, at least you can compound that dividend while you're in it. Okay, so value stocks are often in hated industries. Imagine buying a bank or an oil company in the last year or even right now. I know many of you are like, ew, no, I don't want to own any of that, right? And for various reasons, but even just it's so out of favor and nobody's really talking about it or caring about it. Same thing with some retailers, right? Not everything is super hot like a Lululemon. Lululemon now is trading with a forward PE of 50. So it's not a value on any kind of valuation metric, ticker LULU, but it's one of the hottest retailers, right? But then there's Columbia Sportswear, which is also in similar apparel, shoes, outdoory, athletic wear. kind of things, Coats, similar to Lulu, and Columbia Sportswear, COLM is the ticker there. They have a PE of only 23. Now, 23 is a little pricier than what normally you might want to pay for a value stock, but if you're comparing it to Lulu and in similar category as Lulu, similar customer as Lulu, then Columbia's looking more like a deal. And I've been looking around at Columbia for a while because I really like their business. They are global. But it just hasn't gotten quite as cheap on a PE ratio that I would want it to be at. So I have it on my watch list. And that's another thing you can do. You can put things on the watch list and just kind of monitor without actually getting into it yet to see if you can get it cheaper. Maybe there's a correction coming to the stock market. Corrections are usually about 10% pullbacks in the S&P 500. So maybe we're going to get a 10% pullback. Well, most stocks will pull back along with the entire index. And so maybe I can get it down near a 20 times. And maybe I feel like that's cheap enough for me to get in there. So keep a watch list. Nothing wrong with that. But also be careful. Do your research. Know that there are reasons that some companies are cheap. The best value investors buy companies that are at the top of their industries, which the market may be ignoring. So think about that with even Columbia Sportswear and Lulu. Obviously, Lulu's probably the pinnacle of the athleisure wear company in the industry. But Columbia Sportswear, not that far behind, or something like North Face, which is owned by EF Corporation or VF Corp. VFC is that ticker. You might say that those are hanging in there right in with the action. So you want to get those that are towards the top, very competitive in their industry, and not the ones that, maybe put out of business by whoever is at the top. So one we can talk about is Facebook. I've covered Facebook, ticker FB, on this podcast before when I looked at can growth stocks be bought by value investors. And I don't think many people would argue that they're not among the top in their industry in social media. Facebook clearly is. Instagram even continues just to crush its competitors. Facebook still up there at the top. But the market has put it in the doghouse. It is among the cheapest of the FANG stocks here. Now, I'm not saying it's trading at 15 times because it's not, but it's still in the low 20s, and that is cheap on a valuation basis compared to many of its other social media peers, as well as the FANG peers, if you want to consider them all to be peers in the FANGs. But so that's something to keep in mind. You don't necessarily have to choose, and you shouldn't choose, those that are completely down on their luck and being crushed by the top guys to find value. So keep that in mind. A lot of people think it has to be struggling in the industry, and that's the only way you'll find value, kind of like the GameStop, right? That is clearly struggling in its industry. That's one of the turnaround plays. It's not at the top. Those are much riskier investments because it's not, at the top of the competition list. So keep that in mind as well. And here's some more tips. I'm just going to lay out a bunch of them for you so you can try to keep some of these in mind too as you're trying to look for what stocks you want to buy and how you want to begin as a value investor. So number one, never buy a stock as an investment where you don't even know what they're doing. And I'm not talking about trading it. That's a different animal. This is all about investing in it. Because as an investor, you're buying the company. You actually own shares in that company. So don't buy it if you don't know what they even do. So that's the first thing. Number two, you can buy what you know. If you are a big fan of a certain product or a restaurant chain or, a CEO even, like a Tesla, you have insider knowledge basically based on your own experience with that company and its brand. So if if you love the idea of an electronic vehicle, then maybe buying Tesla or a GM or something else that's in that industry should be where you should be looking. Or on the converse side, if you've never been in an Ulta store, if you're like, Ulta, what's that? Then you should not be buying it. Don't get sucked in on something where you have little knowledge of it, because that's not fun. Who wants to buy that? You should buy things that you are interested in, because again, you are owning it. And that goes to my third tip. For something like, it doesn't need to be a hidden company to be of value. So, you might be a gamer, you might be big into gaming, and maybe you're still trying to get that PS5. I know they're still on back order. People are still paying like hundreds of dollars above the normal price on eBay for them. But Sony, who makes PS5, is rolling out more of them, ticker SNE. Sony's been around for 50 years at least, if not longer. It's not hidden, but yet the stock has remained cheap. It's trading even right now with a forward P of just 15.3. And it's hitting new highs, and it has been over the last year as anticipation of the PlayStation has picked up, basically. But it has a lot of other products. It actually has a semiconductor division. It's number one in its area on cameras. Yes, people still buy cameras, even though they're on their phones. It does have a smartphone division, but it's awful. They're not number one in that. They have a movie division, which is not doing well right now because of what's happening with the coronavirus, but it will resume at some point making movies. It owns the biggest music catalog in the world, basically. I could go on with all of the things that Sony is in, but it's basically been ignored. It was considered boring. The street was like, meh. It did start a turnaround plan a couple of years ago. It's got great management, and they've stuck to it, and the things they wanted to do have actually occurred. So Sony is still cheap, and it's not hidden anywhere. It's, again, a massive corporation, but it is still a value. So keep that in mind. You don't have to buy these small little companies that nobody's ever heard of to get a big winner, to get good companies. Number 4 tip is don't buy the penny stocks. I know they seem fun, those 50-cent stocks, right? Oh, it must be a value. It's only 50 cents. But no, if you're going to trade, that's a different story. If you're going to invest, look beyond any of those types of stocks, because we're buying the company. And something's going on if it's trading under $1, and it can be delisted as well. Once it goes under $1, if it's on something like the NASDAQ starts to issue warnings to the company. All these things happen. So, yeah, you really don't want to be in anything that's, the penny stocks, but even under $5, I would say look at it very closely. Try to figure out, why is it really trading down here? Do the best winning companies trade under $5? Ask yourself that, because we want to buy those that are at the top of their game and not those that are being crushed down at the bottom. Okay, tip number 5, be careful of stocks with really low PEs. So this kind of goes with tip number 4. If it's too low to be, if it's just too low to be believable, then something else is going on there. So you're going to have to do a lot of research if you see a company with a PE of like 2 or even 3. I don't even know how many there are that have that. It's not many, but something else is going on with the business usually to have it be down that low. Okay, number 6, have a diverse portfolio. I already kind of talked about this at the beginning, but you need more than one stock. I know you're just starting out, so you're going to be, in only a few things, and that's okay in the beginning. But you're going to need to buy in different industries. You might want to buy different size companies, some big, some middle-sized, some small maybe. You want to buy some with the dividends, maybe some without, and you can use ETFs to get more diversity in your portfolio. So over the years, people have studied this question about what makes a diverse portfolio. It's apparently anywhere between 10 and 20 stocks, individual stocks, gives you some diversity, probably a little closer to 20. So that's a lot, right? So keep that in mind, but you're just starting out, so you're going to have fewer, and that's okay in the beginning. Tip number 7, it's okay to buy the growth stocks. You can find some of those with value within an industry, and sometimes you can even find a value stock that has growth that the street is just ignoring. So those are rarer, and I always call that a powerful combination. If you can get growth and value, you are golden. And I'll do another podcast about the growth and value stocks because I haven't done one of those with the combination in a while. So be sure to check in because I will cover those. But remember, I've said this before on other podcasts, there's no rules with what your portfolio can look like. And just because you like value investing doesn't mean every stock has to be a pure value. You can buy some stocks that have growth or just that have value within their industry. I've talked about this on the prior podcast, and in this one, but Facebook is being overlooked. It's in the doghouse for various reasons. But that's among the cheapest of the big fangs. So that's an example of finding value among the industry. Or Columbia Sports versus Lululemon. That's another example. In the same industry, and Columbia is somewhat being ignored by the streets and has that lower valuation. So tip number 8 is you will make mistakes. And it's okay to change course on a stock. I've had plenty of losers over my investing life, and you will too. I've even had one company go bankrupt. It was a retailer. I didn't think they would go BK. They had over 300 stores in the U.S. and internationally. And I thought, oh, no, they'll turn it around. They put in some new management. I thought they would be able to. I thought they had a strong enough brand, but I was wrong. And they did go BK. I did manage to sell out of some of my shares right before the BK announcement, but I was caught in some. And just so you know, if you're caught in there, you become a creditor to the company, and basically you probably will get zero. So you will lose it all. Just keep that in mind. That's why I always say try to buy the winners, those at the top of their industry, and not necessarily these, shakier turnaround stories. Sometimes you can get lucky with the turnarounds, and they do make it. But a lot of times you get burned. And in this case, I did get burned. But again, you only need to have, a couple big winners because those can completely overwhelm any kind of losers that you may have. So look at Berkshire Hathaway's portfolio, Warren Buffett's, for example. Apple has just been tremendous since he bought it in 2016 and in the last year. So Apple, of course, ticker AAPL, it's up 74% in the last year, but he's taken big losers in that time period. He sold for a loss on his airline stocks when the pandemic hit. So there was a couple $1 billion lost there. But because Apple continues to just soar, he can get away with having these losers or taking the losses because he has a big enough winner. Now, he's also done the things I've said. He's changed course when something wasn't working out. You don't have to stay in the trade forever and be a martyr or say, I know it's going to work. You can just get out and wait it out on the sidelines. He owned IBM as well for several years. It was a huge position in his portfolio. He stayed with it for a while, but they're just not growing that revenue. They're just not doing the things he wants to see a company do. So he did sell out of it. I don't remember if he took a loss. It might have been a small loss on those shares. But you change course and you buy something else that you hope will perform better. So keep that in mind as well. So these are just some of my tips. There's going to be more as I think about it, because it is hard to be a new investor, and especially in value, because it takes a strong stomach to be a value investor. I'm not going to kid around, not going to lie to you. You think you're right, and the street is telling you you're wrong for a long time. And, we have some examples of that right now. I'm thinking of the home builders, which come up in our value screens all the time. I think all of them are trading at 10 times or less. Some of them are trading at like 6 and 7 times earnings. They're posting record quarters, and the shares are literally going nowhere or even down right now to start 2021. So as a value investor in the home builders, you have to be strong and think like, I know that they're going to grow these earnings for, the rest of 2021. And these are cheap enough that, yes, it makes sense for me to own this. And I believe that they will go higher eventually. But right now, it's value investors against the street on even the home builders. So it's a lot. So be sure to keep tuning in to the Value Investor Podcast, because we're all in it together. And I'll be bringing you value stocks throughout the year, value ETFs, anything else going on in the value industry. I talked about the short squeeze stocks. I hope you sold out of those if you were caught up in any of them. The ones that went really crazy, some of the other ones that were only up 20 or 30, 40% on a move in. Some of those you might have wanted to just stay in because you are a long-term investor. But, there is a lot going on in value investing right now, and there are still value stocks out there. I'm still able to find the AbbVies of the world, again, trading at 8 times AbbVie. So keep that in mind. And even Sony, which is changing its ticker actually, but Sony SNE right now. Let me go over all the tickers I talked about so that in case you wanted to write one down, but you weren't quick enough, I can give them to you again. So I did talk about Netflix to lead it off because those earnings are soaring here, but it's got the higher valuation as it always has throughout its whole life, basically. Netflix, NFLX. Then we had Canadian Solar, more expensive now, but it was cheap for years and years. You had to have a strong stomach to stay in these solar stocks. CSIQ. GameStop has pulled back. It's not as low as it used to be, but it was a value stock for several years. GME. Then we have AbbVie, which I just talked about, ABBV. Lululemon, I own it in my own personal portfolio, but I did buy several years ago. I'm not adding to my position here. It's trading at 50 times. I still love it, LULU. Columbia Sportswear, I've been eyeing to try to see if I could get a good entry point. It's trading at 23 times, ticker COLM. Then we have Facebook. I own Facebook in my own personal portfolio, but I bought a couple years ago as well. But this one at the cheapest of the FANGs, ticker FB. Then there's Sony, still cheap, still killing it. PlayStation 5, SNE for right now, but they're changing their ticker to Sony. So you can't forget that one, SONY, when they change it. And then we rounded it up with Apple, more expensive than it's ever been on a PE basis now after this big rally in the last year, trading above 30 times now. So no longer the value like it was in 2016, but ticker AAPL there. So again, be sure to get us somewhere. We are on Spotify. I know many of you are listening on Spotify. We are on Apple Podcasts, of course. We just joined Amazon Music. If you listen to podcasts on Amazon, you can get us there. But be sure to get us somewhere so that you're listening in next week as I'm bringing you more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.